It's a new month and a new quarter. Good morning and welcome to Business Morning. I'm Chimeze Obi Iwabu. We kick off on the global oil market scene as prices rose this morning after an industry report showed crude inventories in the United States fell much more than expected, suggesting demand is improving even as the coronavirus outbreak spreads around the world. Brent crude rose 33 cents to $41.60 a barrel after declining more than 1% on Tuesday. U.S. crude was up 42 cents at $39.69 a barrel, having dropped by 1.1% in the previous session. Data released by the American Petroleum Institute late on Tuesday showed U.S. crude and gasoline stocks declined more than expected last week, while distillate inventories rose. Crude inventories dropped by 8.2 million barrels to 537 million barrels against analysts' forecasts for a draw of 710,000 barrels. Inventory data from the U.S. government's Energy Information Administration is due out later today. Still, prices are likely to be capped, analysts say, as the world is awash with oil after the coronavirus caused demand for fuel to drop by around a third. In the meantime, the International Monetary Fund expects the impact of the COVID-19 pandemic to cost Nigeria and other oil exporters in Africa a total of about $34 billion in revenue. The projected decline in revenue is attributable to the dwindling global crude prices. IMF's Director, African Department, Abebe Selassie, disclosed this at the Africa Ministerial Roundtable on COVID-19 impact on the energy sector in Africa. He noted that African governments will be under intense budget pressure and rising debt burden, adding that such burden will be higher among oil exporting countries. The IMF noted that since the 2014 oil price collapse, production and investments of most African oil exporters had been on the decrease. The institution blamed the decline on structural issues, governance and security concerns in several countries, especially in Nigeria and Libya. And the Senate President Ahmed Lawan says the presidency is on board with the National Assembly's decision to halt the hike of electricity tariff from today, July the 1st. According to Senator Lawan, the timing is poor considering the impact of COVID-19 on the economy and the fact that proper metering has not been achieved across the country. He spoke to State House correspondents after a closed-door meeting he and the Speaker of the House of Representatives had with the Vice President at the Presidential Villa in Abuja. The National Assembly leadership had earlier met with President Muhammadu Buhari on the same matter.
We are sure that that announcement of the increase in electricity tariff in Nigeria is untimely, and we believe that we need to do more work to ensure that before any increase, there must be some measures, some steps, and some line of actions that must be exhausted, including the metering. And this is a welcome idea to the Vice President as well. This is when they provide services, efficient and effective services to consumers, that they can make money. But in the process, as a government, we too must ensure that we discharge our obligations as provided for in the share purchase agreement signed. And once we're able to achieve that, we would have a better situation in the power sector in Nigeria. It's doable. It has happened elsewhere. So we cannot continue to give discourse and GENCOS the resources that we could ordinarily deploy in building schools and hospitals. But whatever is necessary for us to do as part of our agreement with them, we must do those.
And the Nigeria Employers Consultative Association, NECA, says 74.2% of businesses have stopped operations owing to COVID-19 pandemic. This is part of the findings of its survey conducted recently. The survey also found out that 15.8% are either fully on site or teleworking. Over 90% of surveyed enterprises noted that limited cash flow was an impediment to operations, and over 90% stated that demand for their goods and services has significantly reduced. And so NECA is calling on the federal government to extend the stimulus package to organized businesses. Joining me now is the Director of Membership Services at the Nigeria Employers Consultative Association, Adewale Oyerinde. Thank you very much, Mr. Oyerinde, for joining us on the show.
Thank you for having us.
So what was the objective of this survey? What necessitated it?
Thank you. Basically, we are employers' representatives, and the pandemic affected businesses significantly. So our focus, one of the key objectives of the survey, of the research, was to assess business needs. Businesses have been impacted terribly. Then what are the needs for them to continue to sustain? So that was the main focus of the survey. Gauge the temperature of businesses, let's know how they are feeling, and let's know the support they will need from government and from other stakeholders for them to continue in operation. For us, beyond advocacy, beyond advocating, one of the key components of good advocacy is evidence-based research. And we feel before you communicate to governments that do this for business, then we must have a basis, an empirical basis for what we are communicating. And all our interventions, all our correspondence to government, what we have asked in specific terms, they all flow from the research. At the point we said there's need for government to relax the lockdown, because we know sustaining the lockdown will translate to more businesses facing more difficulties. And when businesses are closing down, it translates into unemployment. Unemployment translates into other social issues. So for us to avoid a tsunami, as we call it, we feel it's important for government to balance economic imperatives with health and safety. So all our interventions, all our comments from my principal has been based on the outcome of the research and what we've pushed to government and what government has implemented in some instances.
All right.
Are those outcomes of those research.
Okay, before we go into the nitty-gritty of your findings, how do you categorize your members or the organized businesses? Because I know the CBN stimulus measures, which include the 50 billion naira for the SMEs, and we have 100 billion naira for the pharmaceuticals, and 1 trillion naira for manufacturers. So does it mean that your members don't fall into these categories?
The research was conducted, it's instructive to note that it was conducted between March and May, basically to gauge, that was the critical times when businesses were locked down, when there was total lockdown. And as you said, our members include the manufacturers, the SMEs. In fact, we are Nigeria Employers Consultative Association. So once you are an employer, then you ordinarily should belong to NECA. So the intervention by the CBN, intervention by COVID, intervention by other stakeholders, were coming towards the end of April, end of May, and the bureaucracy also of assessing those interventions is something else. And I know the CBN also have said in recent times that the responsiveness of businesses to take those facilities is low. And we have said, prior to COVID, the economy was struggling, businesses were struggling. Now, COVID-19 came and caused more damage, Now, giving a business that is already dying a loan is probably adding more burden to its business. So we have advocated, look, give grants to such businesses for them to remain operational. It's in our best interest, our enlightened self-interest, to do that for all those
now,
businesses.
Did this advocacy come before the central bank announced those stimulus packages? Because those stimulus packages are not grants, they are loans.
They are loans. It's been going from the beginning of the COVID. We have reached out to government, we have reached out to the task force, we have reached out to all critical persons in government, critical agencies that are intervening one way or the other in this pandemic. We have shared our thoughts. This is what we feel. This is what we think. This is what we know that other countries are doing to keep their businesses running, to keep the economy running. And we feel government should, if they can do in totality what those countries have done, at least some of those critical interventions, government should be able to do it. Those interventions have been communicated to government.
Okay, so tell me, what were your major findings in this survey?
One, the survey, as we all know, research are basically to do two things. One, show you the state of things, or the state of a system, and then also give you the opportunity to make informed decisions or to plan ahead. So one of the findings is the one that has been in the press is the issue of businesses closing down as a result of COVID-19. That is a fundamental one because it has consequences for others. Then we also found out about 68% of businesses, even in the pandemic, said, okay, they are not considering retrenching, while about 32% said, yes, they are contemplating relaxing the number of employees they have. We also checked what specific needs and interventions, because that's the main focus, will they need from governments to help them to continue operations. That will also come out. And we also find out that a lot of businesses, we gauge how much of those businesses are actually insuring their businesses. And the outcome, they're not so pleasant, but it gives us an inkling of what exactly we should be seeing, what exactly we should be asking government to do, and what are the interventions, specific short-term, mid-term, and long-term interventions that government should do and that businesses should also do. Also, one of the critical things we came up with is we shared a business continuity document with our members, flowing from the challenges, is also to help them to tidy up their internal processes, look at their costs, look at their operations, and make sure that, look, they do the needful so that they remain in operations. During the COVID-19, no matter the level of operation, 10%, 20%, 30%, the most important thing is keep operating, maintain staff as much as possible, so that long term, we all come out of the COVID.
Now, how exactly did 74.2% of enterprises become inoperative, as a result of COVID-19? Is it not possible that these could be businesses that have been struggling even before COVID-19?
4 things drive businesses, basically. One is a hospitable environment, business environment. The second is cash flow. Cash flow, you have cash to transact businesses. The third one is inputs. Inputs, either intellectual, either material, the context of raw materials. And the fourth one is demand. You produce, people must buy. The lockdown compromised the 4 of them in different degrees. Businesses' cash flow was almost turned into zero. They can't even access credits. Raw materials, because of the total lockdown nationwide, raw materials couldn't move from state to state until Advocacy came in and governors started relaxing the lockdown, total lockdown, and allowing interstate travels. Then the issue of inhospitable environment still remains. So all those 4, and disposable income of the individual, of the family, also reduces. So even when businesses are producing, there's no corresponding demand to make sure they keep producing. So COVID-19 compromised the 4 of them. And naturally, when those 4 are compromised, an environment that is favorable, cash flow, you can get raw materials, and demand is not coming.
Well, these are for businesses that are into production, manufacturing, basically. But what about those that are not into production, that are running their business?
Those not into production, you still need an environment that is favorable for you to operate. You still need some level of cash flow. I mentioned input in the context of physical and intellectual. You still need those 2 inputs. If you are not buying raw materials to produce, then you still need intellectual input. And because of the total lockdown, you can't even operate in that environment. And whatever happens, all businesses generally, whatever happens, you still need demand. Whether you are in services, you need demand. Whether you are in production, you need demand. Whatever sector you find yourself,
so what industries were worse hit? Yeah. Or sectors or industries that were worse hit? What was your finding in that area?
The worst hit industries, we have the aviation, we have the manufacturing, food and beverages. Even when there was, after the conversations, underground conversations, government agreed that, okay, essential services should operate. Those were worst hit. At the time, the relaxation was 9 to 3. And for most manufacturing organizations, you realize the time to warm up the system, to warm up the production line, it takes a bit of time. So before you get to 3 o'clock of closing, then your system has already been compromised. So aviation, manufacturing, food and beverages, almost all were impacted differently. So it's a whole game of struggle. It's a whole game of survival, and it's a whole game of just staying afloat. Anyhow, you can.
Now, for your members that perhaps benefited from the stimulus package that came from the central bank, how did that help their business?
Well, it is arguable, to say that they have benefited from those packages, except if there is no specific data from the agency, from CBN, to say this is the number of businesses that have benefited. This is the number of businesses that have benefited. Part of the feedback
well, quite
we've
a number of them have received the money.
Yes, part of the feedback we've gotten is the bureaucracy. Going into who have received and who haven't received is a different conversation entirely that we want to go to in this session. But it is arguable to say that the majority of those businesses have actually benefited from the interventions. From feedback we've gotten, some have tried to, and they've hit brick wall. So it's arguable to say businesses have actually benefited from the interventions. So except the agency, the CBN will come and share those data, these are the agencies, these are the businesses that have benefited, these are the SMEs that have actually collected those facilities, these are the multinationals that have collected. Then it will give us an opportunity to make appropriate comment on that.
Well, I'm sure that during your survey, your respondents must have told you what their immediate needs are.
Yeah.
What are they asking from government now? What are you, as an advocacy body, asking from the government for your member?
Key for us is we've asked government to come up with a job retention scheme. A job retention scheme is all-encompassing. A scheme that will enable businesses to continue to operate, a business that will help businesses to keep employment, a scheme that will help businesses to not only the short term remain, but the long term to be sustainable. And part of it is tax reliefs. Yesterday in the papers, and the IMF also warned that aggressive tax collection at this period will be counterproductive for us, for the country. So we should allow businesses to stabilize before we go aggressively into tax. So tax reliefs, we've called for support in salary payments for businesses that are unable to pay salaries, that are struggling to pay salaries. Because on the long run for us, we've said you cannot deal with the issue of recovery from one end. In the US, in the first 3 weeks of the pandemic, about 17 million requested for unemployment support. Now, those 17 million, they weren't just walking the street before. They were in employment. That means it's likely that businesses closed down. That was why they run to unemployment. In Nigeria, we've said, yes, certain levels we have a degree of unemployment. And about last week, the vice president also mentioned that, look, about 34, 39% might run into unemployment by the end of 2020. That number, they are not walking the street. It's likely that they lose their jobs because businesses close down. It is unlikely to say that, yes, we have graduates, more graduates coming to the system. That's why the number was increasing, because during this pandemic, schools have closed, so no graduates is graduating. So the most likely reason why the unemployment rate is increasing is because businesses are closing. So for us, we feel, deal with the cause, not the effects. Start recovery from business issues. Support businesses to be sustainable. Then once they are sustainable, you have dealt with significantly the issue of unemployment. And once you deal with the issue of unemployment, it has a reverberating effect on the economy, as it were.
All right, just a quick one before I let you go. I'm sure your survey must also have given you an insight of what doing business would be like post-COVID. Yeah. So what did it tell you?
Well, the first thing for businesses, as it were, and one of the things that the research came up with is, COVID will be with us for a long time, whether the vaccines came out or not. But the challenges of working the new normal will always be there. So businesses must brace up for technology. Teleworking, working from home, and brace up also to provide those infrastructures that will enable employees to actually work and work effectively from home.
All right. Thank you very much, Mr. Adewale Oyerinde, Director of Membership Services at the Nigerian Employers Consultative Association. Thank you for your time. Well, still to come, we'll look at Nigeria's economic sustainability plan after the break. Do stay with us. As part of the strategy to create jobs in reducing the effect of COVID-19 on the youths, the federal government planned the employment of 774,000 Nigerians. These youths will be engaged in special public works program aimed at cushioning the effects of economic downturn. However, these jobs seem to be in jeopardy as there are some controversy between the Minister of State for Labor and Employment, Mr. Festus Keyamo, and the Joint Committee of the National Assembly on Employment and Labor. Now, this job creation strategy is also contained in the economic stability sustainability plans submitted to the President sometime last week. Now, joining me now to look at these whole issues is a development strategist, Dr. Emeka Okengwo. Thank you very much, Dr. Okengwo, for joining us on the program.
Pleasure to have me. Thank you.
So what do you make of this drama yesterday between the Minister of State for Labor and Employment and the Joint Committee of the National Assembly on Employment and Labor over the planned employment of 774,000 Nigerians? I mean, for a country that is serious about getting its people out of poverty.
Well, it is what it is. It's what it is. It's drama. But in that drama, you also now have, what you might be able to call, two things that can be deduced from it. Did the minister, was he right in taking the position he took? Yes, he was, because by law, administratively, once the act of the plan is. The national budget is planned, then it becomes an act, and whatever it is that comes out of it, it can only be oversighted by the National Assembly. So on that point, operationally, he's right. But again, you must also give it to the National Assembly that as a representative of people, they might also want to be involved in the process to make certain that their people get the best deals, because that's why they're elected. So in being a drama, yes, you might be able to say it's a little dramatic, but I mean, that is what you see in a democracy. It's all about, people struggling to be heard, people struggling to be seen to be doing the proper things. So I don't think it's a very major, it's just a flash in the pan, if you ask me. But again, it raises also some serious issues about, the synergies that have been built, between the legislative and the executive arm of government. I believe that before that, event, there should have been some, backyard meetings, for the issues raised to have been ironed out before it was brought to the fore.
Now let's look at the whole economic sustainability plan of the federal government. We've witnessed several plans in the past. We had the ERGP, Transformation Agenda, Needs, 7-point agenda. In what ways are the economic sustainability plan different?
It's different because this is one plan that is target-based. It's one plan that is planned around, the COVID, pandemic. Okay, these other plans were very general, but in this case, government looked at the situation, looked at the global economic situation, and then came out with what you call a target-based plan. And it's a very well-articulated plan because, the assumptions that were used in drawing the conclusions, were also well thought through. Okay, you can talk, maybe if you allow me to discuss maybe one or two of the assumptions. Assumption number one was that if you left the economy, the way it was without any injection, any capital injection, we are going to be getting about 4.4, 4.5 negative growth. If you injected 500 billion, it was going to reduce to about 1.9, percent. If you put in 2.3 billion, it was going to be reducing to about 0.59, and then 3.6, trillion that was going to making it 0.46. And I think in the wisdom of those, who evaluated the plan, they decided to go, for the middle road, which was the 2.3 injection. What's good about it is that also the funding streams, of course, the 500 billion, the 1.1 trillion that was to come from the central bank, and then the rest of it that was supposed to have come from, other financial sources. It's a good plan. But that is what it is, a plan, okay? A policy, if you may. At best, maybe what you might be able to call government a fiscal strategy paper. But plans have two other legs that are very, very important. That is the program and the action. The moment you have a plan, it is from your plan you begin to draw your blueprints. It's from your plan you begin to draw your programs. It's from your plan you begin to draw your actions. And that is where your plan now begins to, the plan is the talk, if you may, and then action and program is the work. So I think what needs to be seen is how we're going to be walking the talk.
Now, the lifespan of this plan is about 12 months. Can all the plans be accomplished in 1 year? Is this not rather optimistic?
That's what I'm saying now, that you need to have the program. Okay, it's a plan. A plan is not actionable. It can only become actionable when you now begin to build the parameters. Okay, the monitoring framework. Okay, the project development framework. What projects you're going to be starting from first. I mean, you've just made allusions to one of them, which is the employment of 1,000 youths. If it is made in controversy and is not able to be resolved, of course, it's going to be affecting, the timelines. So what plans basically do is that they make projections, okay, to be able to say within the next 1 year, we intend to achieve A, B, C, if all things are equal. And for all those things to be equal, you must be able to develop, what you now call, and this is where you actually align, your physical strategy with your monitoring strategy and even your trade strategy and all that. This is where all these policies will come together to now form what you might be able to call, if you may, your Marshall Plan or a blueprint. 12 months, I think, is a little too short. We might not, and again, with plans, they are not cast in stone. If in 12 months they are not able to achieve it, I think what we'll do is to be able to do a rollover. But what's critical for me is that for the first time in a long time in this country, we're actually developing a plan that is focused, primarily and specifically on the real sector of the economy to be able to protect and create jobs. That's very critical. We've never had, such a program before, and I've been in a lot of these plans, if you ask me, But for this, if we pursue it now with these other two legs, which is now make certain that we now develop a framework, okay, where you now probably have your project monitoring and evaluation, and then your project implementation. This is where your funding, will come in. I think we'll go a long way with it.
Now, the commitment of government to lift about 100 million people out of poverty by 2030 was, of course, affirmed in the document. But so far, have you really seen, you talked about implementation and working the talks. Have you really seen any seriousness that, yes, this, target 2030 is quite realistic?
It is if government, again, Chimezie, let's focus, let's not look at the plan. The plan is what it is, it's come out. And like I said, the assumptions that were put into, reaching the outputs of the plan are quite well articulated. I mean, they can go. But it's one thing, for you to be able to create what you call dummy corridors in development planning. Is another thing for you to be able to walk the talk, like I earlier said. Now, what's important for us to do is to look at those critical sectors that are be able to lift people out of poverty. And that's why I say I'm very excited that for once we are focusing on the real sector. And if you're focusing on the real sector, there are two broad sectors you want to look at when you look at the real sector. One is your agri sector. But like I always want to argue, I don't like the word agriculture. I like for us to be able to go the way of agro-allied resources. That way you're bringing in technology. That way you're bringing in infrastructure. That way you're no longer just talking about agriculture for food sustainability. You're also talking about agriculture for even, your medicinal needs, for your infrastructure, for even your housing. So when you talk about a plan that intends, or the program to be able to get 100 million people out of poverty, China did it in less than 20 years. We can do it. It's very doable. Okay, it is as doable as yesterday. So what do I mean? But we need to be able to look at those things. Okay, I'll give you a typical example, and we've had this conversation severally. For a country that has 86,000, hectares, or 86 million hectares of arable land, less than 10 or 20% of that in use on a sustainable, basis. Imagine what will happen if we committed another 20 or 30 million of those houses into now what you might be able to call purpose-based, demand-driven, agricultural or agro-allied, resources projects. You'll be lifting immediately. You'll be employing about 20, 30 million people immediately. Imagine if we returned a lot of moribund mining facilities, and there are over 50 of them, littered all over the country. We'll also be creating a lot of jobs. So it's for us to be able to look at our natural resources and our natural endowments. We can be able to do it. And that's why I say the plan captures it, and that's what it should do. Be able to say these are the areas. But it is now the programming that now matters. It is now, developing what you call that your implementation framework, what some people will call, a Marshall Plan, what some other people will call a blueprint. How do we start? Where do we start from? Okay, if you're talking about engaging 1,000 youths in your public works systems, how many can we be able to engage in the farms? How many can we be able to engage in the mines? What education do we need? What skills do we need? What technologies do we need to be able to get them to go there? I think we can be able to do. 100 million might even be small for me. We can do as much as 160 million if we have, what we might be able to call a purpose-driven, program to be able to back up the economic sustainability plan.
And how much of a private sector contribution will be needed to really achieve all of this?
Again, the plan also mentioned the role of private sector. For me, I'm in the private sector, okay? And we're looking forward to, government has made a pronouncement. And I'm struggling for us to be able to see that plan as a pronouncement, see that plan as a wish list. Okay, don't see it as the end. Don't see it as the blueprint. Okay, it is now for the private sector to be able to oversight that plan, look at the areas that are able to, probably, make the best impact and best inputs, and then begin to approach government on this. I know, from my little experience and work relations with government, that there are also programs that are coming up that are trying to now, tie. I know for certain, I don't know how public this is, that government is trying as much as they can to bring all the research centers, in the country, across the ministries, under one major ministry. That is going to be able to help in marketing research outputs, okay, for instance. So what is important for us to do is to be able to look at the sustainability plan for what it is. And then remember that when you're doing a plan, there is another P and there's another A that must make that plan to become a successful economic program. That other P is the program, and the A is the action. So it now ties to what you call a plan program of action, PPA. If we put the remaining P and A into this plan, then you can be certain that we're good to go. But the moment you begin to interrogate this plan, and then you're interrogating it against program and interrogating it against actions, then you might be losing, okay, the monetary aspect of it, which is where, of course, the private sector, the banking sector, the investment sector will come into the plan. You can't capture it in this document now because it's going to be driven by relationships that are going to be developed based, okay, on what you may be able to call business interest. And again, based on what you might be able to now call business support, instruments that has been developed based on evaluations of whatever sector that the person wants to look into. If you now look at the plan and say, okay, government wants to lift 100 people out of poverty, the plan hasn't shown how, you might miss the mark. But if you say, okay, there's an interest of government to be able to lift 100 million people out of poverty, all right, let's look at the agro-allied sector. Can we be able to separate them into structures that will be able to now create maybe from animal husbandry, 10 billion, poultry and allied products, 10 billion, this and that, 10 billion, crop production, 10 billion, okay? You begin to now segregate. Then that way, you can begin to now plan, your fund inputs, your infrastructure requirements, your human capital inputs, and all that. That's how plans, now translate into programs and actions.
All right, thank you very much, Dr. Okengu. Let's just hope we eventually get this plan right. Thank you for your time. And for review of Tuesday's trading activities at the equities market, I have Temple here. Temple, well, the bulls couldn't remain in the market. The knock on the three cement giants hit the market heavily yesterday.
Absolutely. I mean, a lot of sell down. That's what we saw yesterday on that side of the market, which closed south. Not so impressive, but yes, I mean, the devil is in the details. Now, this is an opportunity for some folks to actually buy, as we've continued to see bargain hunting across the market. So yesterday, as Chimeze hinted, we didn't see so much of gain yesterday. We saw the steep decline of some 1.53% in the index yesterday, and that's translated to a whopping 198.1 billion naira decline from the equity capitalization of the exchange. That's not too good, because we had actually been thinking that the equity capitalization will touch at least once again 13 trillion naira and something to be able to usher us into the second half of the year. But hopefully we'll be able to regain all of that good positive status. Yesterday, if you look at the activity level, it was positive in spite of the fact that we saw so much of decline, like some million units of shares belonging to FBN Holdings actually contributed more to the level of transaction that we have yesterday. We're up yesterday in terms of activity level by 77%, but 92% up in terms of the value of the transactions that we saw yesterday. If you look at what Dangote Cement alone contributed to, this number that you have here was 612 million naira. And then you have a 10% decline in Boa Cement, then another decline in WAPCO, which is another major cement company that you have in the market. They were basically the major companies that dragged the market yesterday. Look at the activity, look at the sectoral performance, not so good as well. Only the consumer goods segment of the market closed in green. But you look at the banking stocks, where you have the likes of Unity Bank, that was down by more than 9% yesterday. And if you look at Union Bank, too, it was down by more than 6.4% alone yesterday. And then when you put together with all other losses, other banks that also experienced declines yesterday, it gave us 132 basis points decline yesterday. But in terms of the consumer goods side of the market, thanks to Nigerian breweries and of course a couple of other companies that you have in this space, they were positive yesterday, and that's how we sustained this level of gain for this particular class of the market. So industrial goods side of the market, Dangote Cement, Boa Cement, all the key companies that you have in that space were down yesterday, and that was where we had the highest of 7.5% decline yesterday. Insurance side of the market, folks sold off their interest in mutual benefits, and that impacted this side of the market, insurance space, negatively. Oil and gas, we got a 43 basis points decline as well, owing to the impact of O&O, which was also down by 4.17% yesterday. Now we're back to 2 naira 30 kobo. This is quite low. Looks like something that has bottomed out and something that investors might be checking at this point in time, especially if they do their calculations well to see if it's good enough for them to make re-entry at this point in time. But look at Advocacy PLC, made a bit of a comeback yesterday. A modest 0.43% gain yesterday and pushed up the price back up to 11 naira 80 kobo. Let's check out what corn oil number is doing. Corn oil at 21 naira. This is one company to watch for this period. Look at the earnings, which was released yesterday for the full year 2019 numbers. Got 139 billion naira in terms of its top line. That's the turnover, was up by some 14.4%. The post-tax profit was also up by some 9.8%. And of course, the profit before tax was 2.83 billion naira. They are paying out 2 naira in dividend. And that's something that investors are going to be tracking today going forward, because you look for opportunities in the market, that's one that you can get. Japan was down yesterday by 8%. But today is the 1st of July. I mean, it's the first day in the second half of the year. We have Mr. David Adore, stockbroker with High-Cap Securities, joining us this morning. Mr. Adore, talk us through what the month holds for the market, especially in the month of July and for the rest of the second half of the year.
Thank you, Temple. Let me believe that the month of July is not going to be eventful as the market braces up for a poor economic performance results for the second quarter. It's essentially going to be a buyer's market for the equities market. The debt market is expected to be very, very active as activities shift to the debt market, with the migration of financial assets also going to that market. The federal government is expected to be very, very active there in the second quarter, as a lot of debt issues will hit the market from the DMO. to raise funds to finance the Nigerian economy.
Right, so that's a space that we'll continue to watch because, yes, there will be so much of activities at the debts and currency side of the market compared to the equity side of the market. Mr. David Adonri, thank you so much for sharing your thoughts with us. Let's hope that the month pans out better for us all in this year, actually. Thank you so much for sharing your thoughts. Mr. David Adonri is a stockbroker with High Cap Securities, a member of the Nigerian Stock Exchange. Chimeze.
Absolutely. Things will turn out good. I'm always optimistic. COVID or no COVID. All right, we'll do an opening call to London as well as come back to you, Temple, for the debt and currency market after the break.
Has taken a closer look at what Boris Johnson had to say. It doesn't really appear to be just about enough. He's pledged £5 billion to build on infrastructure, which he's kind of repackaged as a coronavirus recovery plan. But really, what a lot of the critics are saying is that this is exactly what he pledged during the 2019 campaign manifesto. And the only difference is COVID has happened. So really what he's done is quite cleverly accelerated those plans of infrastructure around the country, but particularly in the northwest and the northeast and the Midlands region of the UK, who have suffered over 10 years of austerity, which was really kind of steered by the Conservative government. And so that £5 billion that was pledged yesterday, that's only about 0.2% of GDP. So rather than being a build, it appears to be more of a save. And I think what a lot of economists are saying here in the UK is that Boris Johnson does know that apart from trying to get rid of the COVID pandemic and trying to kind of wrench Britain out of the economic situation it's in, we also have Brexit to face at the end of the year, where, you know, depending on which economists you listen to, is going to have a cost factor on Britain's economic recovery. So Boris Johnson, even though, you know, spending and borrowing is at a record low in the UK, he knows he can't borrow too much because we potentially have another economic crisis coming to hit us at the end of the year, whether there is a deal or no deal with Brussels.
And of course, the Bank of England's chief economist, Andy Haldane, spoke yesterday and issued an upbeat assessment and says Britain's economy is recovering faster than previously thought from the COVID-19 crisis, but warns that faster growth could lead to higher inflation. How much of this upbeat outlook cheered the markets?
No reaction from Haldane's speech on the markets. The FTSE opened about 6 points higher this morning, so pretty flat, really. I think the reaction seems to be on the latest information from the nationwide house price index, which has declined for the first time in 8 years. So house prices clearly on the decline in the UK market really picked up on that sentiment, as well as the second wave of coronavirus. There's a new list of London boroughs that potentially could be locked down, similarly to what we've seen in Leicester in the north of the country. But you're right, Andy Haldane, the chief economist of the Bank of England, he was speaking yesterday online, and he really echoed some of the sentiment that we've already heard from Andrew Bailey, the Bank of England governor, and that's that the economic recovery in Britain will not be as harsh or as drastic as people once expected. He is more concerned about stark levels of unemployment, which is the main concern from the Labour opposition party, as well as business lobby groups, particularly as the furlough scheme is coming to an end in October. And I know that the media were trying to get Boris Johnson's reaction yesterday on whether or not that furlough scheme could be extended for some sectors in society. But yes, Haldane did say that monetary policy can only do so much. He, of course, was the only MPC member to vote against stimulating the economy, even though it won. But he said, but monetary policy can do relatively little to avoid problems such as structurally high rates of unemployment. So high rates of unemployment is definitely the major concern for Haldane. But he does say he envisions a V-shaped recovery for Britain.
And in another development, it looks like the UK government is planning to make a switch in policy over Huawei's 5G network because of US sanction on the Chinese company. But would this mean a breach of agreement?
it won't be a breach of agreement, Chimezie, because Boris Johnson did announce that he would be allowing Huawei to build, I believe, up to 35% of Britain's 5G network. But still, that needs to go through Parliament and it needs to be voted through to become legislation. We're not there yet, and it appears, if we listen to Oliver Dowden, who's the UK Culture Secretary, that may indeed not be happening. He was giving evidence to Parliament yesterday, and he did say that he doesn't envision Huawei to be part of Britain's 5G network building in the long-term future. And Britain is welcoming new vendors. Even Samsung was put into that. So that's a really kind of a shocking announcement that was made yesterday. But then not shocking in other ways, because Britain's relationship with China has deteriorated over the past couple of months. Of course, they're not happy with China's reaction to COVID-19. There's a lot of misinformation that has been accused by Beijing of coming out of the area. And of course, Hong Kong. At the moment, there have been clashes overnight. So the security situation there is really heating up. And of course, Hong Kong is a former colony of Britain, so they're not happy with these new Chinese national security laws. And that, of course, will bleed into the reaction of Boris Johnson if indeed they do decide to let Huawei build, controversially, part of their 5G network.
All right, we'll wait for your update later in the day, Juliana. Thank you. And back here on the debt and currency markets, back to you, Temple.
Yes, thank you, Chimbeze. Before we touch on the debt and currency side of the market, look at our NAS, the OTC. That's where you have unlisted companies. Yesterday, back to a level where things were unchanged. But yes, we're still able to have the NSI, which is the NAS, the securities index, at 715.51 points, actually. The market capitalization is still up at 525 billion naira. Volume of transactions, just 11,450. And if you look at what we contributed in terms of performance here, you've got CSCS doing some 6,000 units of this entire 11,450. And of course, I think 2,000 or thereabouts from WAMCO, then 3,450 from NDEP. That's your Niger Delta Exploration Production Company, which is a refinery that we have somewhere in the Niger Delta. But generally, it's just 3 deals that we got. Now, the debt and currency side of the market, yesterday, here we saw bids open lower across benchmark maturities yesterday. Investors got a bit more order-driven in terms of demand now around the 2035 paper. Look at the March 2025 security, which is priced higher at 119.6 naira. And then if you look at the value of the transaction that we saw across this particular security was 4.9 billion naira yesterday. Now, investors also showed a bit of more interest at the shorter end of the curve. Look at the April 2023 paper. In spite of the fact that it was little volume that we have, there was 600 million naira worth of transactions that exchange hands on this particular security. Then you have the mid-end of the curve as well, the 2026 paper, which is not listed here. There you got a bit of more demand as well. But here you had some offers, and we do hope that these offers that we've been getting across the market, that will also help to sustain the performance and activities that we've been seeing here today. Now, if you look at the NTB side of the market, here you got the longer end of the curve. That's where we got some 1.5 billion naira worth of transactions yesterday, but not so much of activities. Typically, this is typical of the NTB side of the market. In terms of the open market of maturities, the December papers was the key points of interest yesterday. We know that here 2021 paper got some interest and of course some few demands as well on this side of the market. In total, we got just 36 deals yesterday. Now we have Ladi Bello, a fixed income dealer with Access Bank, joining us on phone. Good morning. Thank you so much for sharing your time with us this morning. But we know that today there's an NTB auction. Talk us through what your expectations are around the stop rates.
Good morning. Thank you for having me. So this time around, we have the NTB auction offering about 88.8 billion naira, which is significantly higher than what was on offer at the preceding auction 2 weeks ago. We expect the subscription to be strong, given the interest for NT bills over the last couple of trading sessions. As a result, we expect rates to hover around a similar level on the 91 and 182 days. And for the 364 days, where we usually see most of the interest lie, we expect the rates to close around where It also closed at the preceding auction. If the DMO decides to manage rates, we might see stop rates inch slightly higher on the one-year bill. But as for the 91 and 182-day papers, the supply remains relatively scarce. So we'll see yields continue to trend lower on these maturities.
And on the one-year bill, where that is expected to be higher, that's where we do hope that investors will return to tomorrow at the secondary side of the market to purchase more. Ladi Bello, fixed income dealer with Access Bank, thank you so much for sharing your thoughts with us. I appreciate your time on the program. Thank you so much. Chimeze, it's back to you.
Thank you, Temple. Well, let's hope for a good start to the second half of the year. And it's on that note that we'll wrap up today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.